Morning, committee. We're going to call the meeting to order for February 17th. I apologize in advance. We're a little bit, we're way behind schedule due to being shut down the last 2 days. And so we've got two hearings today, Senate Bill 178, Senate Bill 242. I apologize, you do not have an agenda in front of you. We had testimony coming in as soon as try to get through this. I'm going to open the hearing on Senate Bill 178. Eileen, can you give us an overview?
I sure can. Thank you, Mr. Chair, and good morning, committee. Senate Bill 178 amends PSA 2020 Sub 9-803, 9-808, 9-809, and 9-1717. These are statutes updating banking. We're updating banking statutes to include trust companies. Section 1 amends PSA 2020 Sub 9-803 pertaining to the renewal and extension of corporate existence. Under current law, any bank with articles of incorporation that have lapsed or that shall lapse may renew and extend the bank's corporate existence in the manner provided by law and upon payment of the requisite fees. So Senate Bill 178 would add trust company to the statute and allow trust companies to renew and extend their corporate existences in the same manner as the banks. Section 2 amends KSA 2020 Sub 9-808 pertaining to the process by which a national or federally chartered bank, savings association, or savings bank may convert to a state bank. Senate Bill 178 would add trust company to the statute and establish a process by which a federally chartered trust company may convert to a state trust company. Section 3 amends PSA 2020 Sub 9-809 pertaining to the process by which a state bank may convert to a national bank, federal savings and loan association, or a federal savings bank. And again, Senate Bill 178 would add trust company to the statute to establish a process by which a state trust company may convert to a national or federal trust company. So Section 4 amends PSA 2020 Sub 9-1717 pertaining to persons who may serve as a director, officer, or employee of a state bank. Under current law, no person who has been convicted of a crime involving dishonesty or a breach of trust may serve as a director, officer, or employee of a state bank except with the written consent of the commissioner. The Senate Bill 178 would add trust company again to the statute to prohibit a person who has been convicted of a crime involving dishonesty or a breach of trust from serving as a director, officer, or employee of a state trust company. And I can stand for questions.
Thank you, Eileen. Committee, are there any questions of Eileen? Senator Peck.
Thank you, Mr. Chairman. In the interest of time, are you ready for motion to pass this out favorably?
Hold that thought. Any other questions of Eileen? Seeing none, thank you, Eileen. Our first proponent is Melissa Wagaman, General Counsel with the State Banking Commissioner's Office. Welcome, Melissa.
Thank you, Mr. Chairman and members of the committee. I appreciate the introduction of Senate Bill 178 on our behalf, and also Mr. Chairman for holding a hearing on the bill. I'm not sure who all is with me today from the office. I was expecting potentially the Bank Commissioner David Herndon, the Deputy Bank Commissioner Tim Kemp, and the Director of the Bank Commissioner's Trust Division, Scott Lowery, but I'm not sure if they were able to get on the WebEx or not, so it may just be me answering all the questions. But in any case, the basis for the bill arose last summer when we had a national bank that was outside of Kansas approach our office about coming into our state as a Kansas trust company. And while reviewing the law for that particular transaction, we realized that the Kansas Banking Code does not allow a national bank to convert to a state trust company. The banking code only allows a national bank to convert to a state bank. So we did discuss this issue with the Kansas Bankers Association, and they in turn talked to their trust experts. And between us all, we didn't find a policy reason for the omission of trust companies from the conversion statutes. We reasoned that it was probably just an oversight in the statutory language and that the banking code was written before the laws on trust companies. So the corrections to that conversion process can be found in sections 1 and 2 of the bill. It's national banks coming in as state trust companies, and state trust companies can go out as national banks. So while we were working on that particular amendment, we found some other statutes that should include the word trust company as well. Section 1 of the bill relates to a state bank's articles of incorporation, as Eileen has explained. And then Section 4 relates to persons who have been convicted of felonies and probably shouldn't be serving in state banks. Both those sections have been amended to add trust companies. And lastly, it's always embarrassing to admit a mistake, especially one made while drafting your own bill, but we managed to do that. We do need to point out that we made a mistake with the language that we submitted to Eileen, the reviser, so we are kindly asking for an amendment on our own bill. The name requirements for a state bank are different than the name requirements for a trust company. We missed that in our bill. The attached amendment is my attempt at writing it so you can see what it looks like, but I'm going to bet Eileen's going to want to rewrite it in proper form. But if you look at the second page, you can see that the names for banks are really supposed to be different than anyone else doing business in the same city or town or within a 15-mile radius. Whereas for trust companies, they have to be different or substantially dissimilar from any other trust company doing business in the state. So those are two different standards, and they're in the law for now. We think the bill needs to capture that as well.
Thank you, Melissa. Committee, are there questions? Seeing none, thank you.
Thank you.
Are there any additional proponents to Senate Bill 178? Are there any neutrals wishing to testify on Senate Bill 178? Any opponents to 178? Seeing none, we will close the hearing. Melissa, I do intend to work that bill probably early next week, so if you can get that language to Eileen, we'll have the opportunity to consider that amendment. We will close the hearing on 178. We will now turn our attention to Senate Bill 242. Longer and more complicated bill. Eileen, can you give us an overview? Eileen, you may be muted.
You should have enjoyed the mouth talk moving and nothing coming out. Okay, so as I was saying, the bill may be long and complicated, but the brief is actually pretty short and uncomplicated on Senate Bill 242. So a little bit of information first. Under current law, the Uniform Consumer Credit Code, or UCCC, covers consumer credit transactions, which include consumer loans, consumer credit sales, and consumer leases. Under the provisions of the UCCC, and with certain exceptions, persons engaging in consumer credit transactions are required to file notification with the OSBC. Consumer loans currently include subordinate mortgages, high loan-to-value mortgages, and high APR mortgages. Consumer loans above 12% are called supervised loans, the making of which require a supervised lender or SL license. By contrast, the Kansas Mortgage Business Act, or KMBA, governs any person who is doing mortgage-related business in the state. For instance, mortgage loan originators, or LOs, are always individuals. And while federal law requires them to be registered, states actually do that through state law. And LOs are currently registered under the KMBA. And LOs often work for a mortgage company, or MC, and MCs are licensed under the KMBA as well. So with that, what Senate Bill 242 does is it has removed the mortgage-related provisions from the UCCC and has incorporated them into the KMBA. So if you look at the bill, in doing so, 12 new sections have been created. Approximately 12 statutes of the UCCC were amended to pull out the mortgage-related provisions and leave the remainder of the statute in place. And approximately 10 statutes of the KMBA were amended to incorporate portions of the UCCC provisions. And finally, 5 statutes of the UCCC were repealed completely. So that after all of this, then the entirety of the mortgage provisions would live in the KMBA, and Melissa and her folks can answer the whys and the specifics of where everything went and how it got organized. But other than that, I can stand for questions.
Thank you, Eileen. Committee, other questions? Senator Hildebrand.
Thank you, Mr. Chairman. Eileen, thank you for your explanation. Just a quick question. Do you happen to know the differences between what these statutes look like in the UCCC versus what they look like now as the new ones? What all the differences were?
As far as what they looked like?
Yeah, you said that these new sections were pulled from UCCC. Some were amended, some were deleted, and now put into KMBA. I was just curious if there was a Cliff Notes version of what changed or what's different from when it was in UCCC to what it currently is proposed now. Or am I just in the wrong ball field?
You're close to the wrong ball field, but not quite out of the ball field. The provisions themselves haven't changed because the law hasn't changed. Pretty much, it's just where the law has been living. We're picking it up and moving it. And in doing so, a little bit of the language has been tweaked to make it read a little bit better, but nothing substantial has been changed. Because there's case law, there's history, there's precedent that has been established under the UCCC, and there's notes interpreting the UCCC that goes with it as well. So we didn't want to, or I didn't want to amend it too greatly because it would disturb all of that. So the provisions themselves, we've tried to keep it as close to the original language as possible and just kind of picked it up and moved it.
Thank you.
Committee, are there additional questions of Eileen? See none. Thank you, Eileen.
Sure.
We will now turn our attention to the proponents. We've got Melissa Wagaman with the Kansas Bank, the OSBC Bank Commissioner's Office.
Thank you, Mr. Chairman, members of the committee, for, again, introducing this bill for us and also holding a hearing on it. Again, I'm not sure who all's with me on WebEx. I was hoping to see the Bank Commissioner, David Herndon, the Deputy Bank Commissioner on our consumer mortgage lending side, which is Mike Insbrenner, and Director of Examinations, Jim Payne. But I do know that I have our staff attorney, Matt Shoger, behind me. So he will be taking all the hard questions. Just so as some background and a reminder about the Bank Commissioner's Office, we have 2 divisions. We have the Banking Division, but we also have the Consumer and Mortgage Lending Division. Senate Bill 242 relates to our work on the CML side, where we oversee and regulate mortgages. First off, I'm also probably going to use some acronyms here during this hearing. I usually respond to the Uniform Consumer Credit Code is the UCCC, and the KMBA is the word I usually use for the Kansas Mortgage Business Act. Senate Bill 242 has basically 2 points. The first being that the bill moves the provisions from the Uniform Consumer Credit Code, which relate to mortgages, and it moves them to the Kansas Mortgage Business Act so that we are creating one statute governing mortgages in one place. So in other words, we're creating a one-stop shop for mortgage law in Kansas statutes. Currently, a person has to hunt and peck, basically, to find the mortgage provisions throughout the UCCC. Senate Bill 242 also follows up on some legislation that we started in 2016 that moved the licensing sections relating to mortgages over to the KMBA. The second point that we're trying to accomplish with this bill is we want to update some of those statutes as we move them. They date back to the 1970s. We're trying to look for simpler phrases and some current language and practices so that the public can read these and use these mortgage laws with much more clarity. And that would include banks, mortgage companies, loan originators, consumers, and attorneys who are reading the laws. So to summarize, we are moving the statutes that impact mortgages that are in the Uniform Consumer Credit Code over to the Kansas Mortgage Business Act, which is the state law governing mortgages. And because we're moving only some of the provisions, the mortgage provisions, from the UCCC to the KMBA, we end up omitting some of the provisions, and there are fewer requirements that end up on the mortgage side. The UCCC is really about consumer credit, and some of its provisions really don't relate to mortgages, so we are scratching those during the move. I've listed some examples, and these are all consumer protection requirements, generally aimed at consumer credit and aren't really applicable to mortgages. Consumer protections for mortgages mostly exist in federal law instead, and there's no reason to repeat those in state law. So I talk a little bit about the computation for the finance charge and notices going to consumers that we are not duplicating for mortgages. We hope that will make the KMBA easier to read because it doesn't have these irrelevant sentences. So for example, the list I have, if you look at 2D, for example, it talks about providing receipts. That's a requirement to provide a receipt for cash. And we really don't think mortgage companies are receiving cash for their mortgage payments. So there's really no reason to have a requirement for a receipt. Another change that we have made in Senate Bill 242 is to expressly allow the greater use of electronic means to include electronic payments and electronic delivery of documents. Senate Bill 242 ties to another Kansas law called the Kansas Electronic Transactions Act, KETA. And so it gives the reader notice that electronic transmissions allowed under that other statute are now allowed for mortgage business. We've been working on this project for at least 3 years. I started in the OSBC about 2.5 years ago, and they'd already been working on this project when I arrived. And we have worked to keep interested parties apprised on this project. We reached out to the Kansas Bankers Association in November of 2020 to share our latest draft and to get their feedback. And the KBA raised 2 concerns. They said that they were concerned that bank staff would have to read a second law, the KMBA, when they're accustomed to reading the UCCC. So they'd have to switch gears from reading the UCCC and have to read the KMBA. They were also concerned that banks would need to update forms, that they would have to update their forms to reflect the new statutory sites because the statutes relating to mortgages would change. I'd like you all to know we've had a really long and positive relationship with the KBA. The OSBC and the KBA have always gotten along really well. I have personally known Kathy Taylor for over 20 years and consider her a good friend, but please don't ask her ever about the concealed carry class that we took together. So, you know, it's not fun to stand up here and be on different sides of the bill with the KBA. I can tell you we'll continue our good relationship after this hearing, and we'll continue to work out any differences that we have on any legislation. So while we did listen to the KBA's concerns on Senate Bill 242, we also just wanted the opportunity to hear this bill out loud in this setting, to have the dialogue about the KMBA, and to get all those concerns out in the open for a transparent and productive discussion. Another reason we really felt like we needed to discuss the bill, even with opposition coming from the KBA, is that the mortgage industry continues to move away from banks and moves to non-bank entities. Non-banks originated nearly 60% of new mortgages in 2019, and banks and license, and they are now doing nearly half of the mortgage debt that's outstanding. Our office currently regulates 187 banks. We license 463 mortgage companies, plus about 1,100 branches for mortgage companies. And we have almost 8,000 mortgage loan originators that we're licensing. Those are over on the consumer mortgage lending side. We shared our draft bill with the mortgage industry, and they did not have the same concerns as the KBA, and we received positive feedback for those who did read the bill for its contents, and some even expressed, appreciation for the modernized language. They do think it makes it easier to read. I believe the KBA will propose an amendment today to Senate Bill 242. If the amendment refers the reader back to the UCCC, we believe that amendment destroys the purpose of Senate Bill 242. So we are trying to move the provisions out of the UCCC into the KMBA, and if their amendment takes everything back to the UCCC, you can see how it undoes the bill. So we would prefer not to pass the bill rather than have the amendment, and to take time during the interim to have continued conversations to see if we can work out our differences. Last thing, I do want to walk you through 2 examples that I thought might demonstrate where we're coming from on this bill, and after that, I'd be happy to stand for questions. The first attachment should look like Chapter 16A title page for everything that's in the UCCC. This is the index for the Uniform Consumer Credit Code. All the provisions that are bolded pertain to mortgages, and we bolded them for you so you would have an easier time finding them. But to the typical reader picking up the Uniform Consumer Code, they're reading through this index, and they're going to have to hunt for anything relating to mortgages in this index.
So, unfortunately, we don't have your testimony in front of us. It's back in the email pile, so
Oh, I'm so sorry. Okay,
difficult for us to reference your
Okay.
testimony. Committee, we will have that in your folders sometime today.
all right.
Present.
Here we go. I'm not giving up that easily. Okay, so here is the index pages for the Uniform Consumer Credit Code, and this is 5 pages long, and if you have good eyes, unlike I do not, I wouldn't be able to see it from some of your positions. The bold are the provisions relating to mortgages. So the person, for these folks back here, for the person reading the index, they're going to have to look for all the provisions relating to mortgages within this long index. Oh, okay. There's the first page and the second. Yep, okay. Can we keep going, or is this just for folks? Oh, I see. This is the first time I've had to testify under this situation. Now I'm with you. That's okay. All right, I think last exercise here, and you don't have this example then either, but I wanted to demonstrate how we believe we've written it to make it clearer, and it would be easier to go through with it in front of you. The way we wrote the definition to cover the entities that are moving over, which is mortgages, we called them covered mortgages and a covered transaction. And we used active and clear language. So what we did is we defined a covered transaction to mean a mortgage that is a subordinate mortgage, so a second mortgage, has a loan to value ratio at the time when made, which exceeds 100%. So that's a high loan to value ratio. And then also if it has an annual percentage rate that exceeds the code mortgage rate. So that's if it has a high interest rate. So that's how we rewrote that section, saying covered transaction, meaning these are the mortgages that are covered. Seconds, high loan to value, and high interest. To figure that out in the Uniform Consumer Credit Code, it goes like this. You have to go to the definition of consumer credit transaction. It says that is a consumer credit sale, consumer lease, or consumer loan. Then you have to go to consumer loan. And it has subsection A outlining everything that makes up a consumer loan. And then it has an exception in B that says, unless the loan is made subject to the Consumer Credit Code by written agreement. So there's a possibility that it can be covered if it's by agreement between the parties. It does not include a loan secured by a first mortgage. Okay, so by reading that and process of elimination, that means it covers seconds because the exclusion is a first mortgage. So therefore, seconds are covered. And then as for the first mortgages, there's an unless. So then a first mortgage is pulled back in if the loan-to-value ratio at the time when it was made exceeds 100%. So now we've got the high loan-to-value loan back in. And the next point is the higher interest rate. So have to dissect this section, and it takes a really long time to read it and understand that, oh, I see, okay, seconds, high interest to loan and high value, am I saying that right? High interest to loan and the high interest rates are covered, whereas we're just like using active language and making the list. So those are the things where we think we've written a better law that I wanted to point out.
Thank you, Melissa. Committee, are there questions? Senator Pittman?
Thank you for coming in here, and I commend you and your organization for trying to make these better, more transparent for the consumers. However, it seems like there's 2 or 3 things that are going on here that could be separated out and done in a series of processes. One of those is updating the language to be more modern, like you said, from the 1970s to here with electronic means. That seems commendable. Seems like we could do that in an isolated way. Even if we didn't do the rest of the bill, that in and of itself is value add, right?
Right.
Yeah. So there is value there, and we should be doing that. But I don't quite understand. I know you're wanting to make that language more clear for the consumer, but are we having issues right now with the way these things are separated? Are our banks and our consumers, are they having issues that this is actually trying to help? Because there's a lot here, and moving code from one area to the other seems a little bureaucratic. Even though I know that's the nature of what we're dealing with here, is we're dealing with these statutes, but are we actually solving a problem here for our constituents? I don't see that happening other than the clarity of the language that you think is better. And I'm not trying to be adverse, I'm not catching why we're doing this.
Yeah. What we're trying to do is create this 2 silos. So you've got the law on consumer credit, and that's the 1970s law. The 1970s consumer credit law, and then the silo for the mortgage laws, so that anyone reading trying to find the mortgages knows where to go, and they're not flipping through a 121-page old law trying to find the mortgages. So yes, we are trying to fix it for anyone in the mortgage business, so that they don't have to read through the 121-page consumer credit code looking and hunting and pecking for anything relating to mortgages, that everything will be condensed into one act for mortgages. And we already started down that road in 2016 when we took licensing of mortgages and moved it there. So we're kind of halfway there already.
Senator Olson?
Elaborate a little more on your high loan to value and your high interest rate loans. So what is that notification? They're just notifying the consumer these are high interest rates and they're high loan to value loans? Or who are they notifying?
Did I talk about notification, or did I talk about at the end how we define it? I could probably get an answer to you on the other question, but what I was trying to explain at the end was the definition of what's covered, whether it's in the old law or in the new law. The old law covers certain types of mortgages, and they define them in kind of a complicated way. And we're trying to redefine them so it's easier and cleaner to read in the Mortgage Act. So when I talked about the high loan-to-value mortgage, that's one that falls under both laws. That's what I was talking about. Why it's being moved over.
How do mortgage companies handle that? I mean, if you're a bank, you're a regulated institution, you have policies in place on your loan to value. I mean, what's to stop them to loan 100%? Is there policies in place that they can't loan that high, or, and the same way with high interest rates.
I mean, yeah, the Kansas law does have usury laws, usury caps to some extent.
I understand on the banking side, I'm just saying, who's kind of monitoring what the mortgage company's doing?
We are. Yeah, we oversee and regulate the mortgage companies.
Okay.
I mean, of course, that's on the consumer mortgage lending side of the office, not the banking side. But I can get with you afterwards and
I'm
make
just
sure
curious.
make sure I understand your question.
Okay, thank you.
Okay.
Additional questions? Senator Pittman?
Thanks. One other thing, are we making substantial changes when we move the things from the UCCC over to the other section? Or are you trying to keep all language and provisions intact as you move these things? In other words, you had this example of the high loan, and you said it's difficult to read now, and you went through the exceptions. Are you changing things as you move them, other than to update things to include new provisions for the electronic pieces? I mean, are you actually changing provisions and exceptions and these types of things?
It's a good question, because yes, we're doing a little bit of that. I mean, the original intent was really to move the mortgage provisions out and over to the KMBA, so you have everything relating to mortgages in one place. But then when you start reading language from the 1970s, and you have to do, you know, gymnastics to get through the statute on how to read it and how to interpret it, you say, well, maybe we should just write that whole sentence clearer for the reader, the person who's going to be reading the law. So yeah, we do end up cleaning up the language. And the example I give you, when you get it in writing, hopefully it will make sense. I mean, everything's still there. We've just rewritten it in basically active voice and, you know, just clear, succinct sentences versus a lot of, but if this, then that kind of language. So yes, that is how we're editing things.
I'm just wondering, are we changing that, say that provision? Are we changing provisions that were there in place in the 70s? Are there a lot of these substantial changes about exceptions and these types of things? What you describe is more clear language, which I appreciate. But is it that we're changing policy when you're doing that translation? Are you actually changing what happens in that circumstance? And is that happening in quite a few places?
I don't think we're really trying to change policy. Mr. Chairman, can I have the staff attorney, Matt Shoger? Matt Shoger helped, he wrote most of the bill draft for us, so he'll probably be better to explain. Matt, if you want to come up here, they can't hear you without the mic.
Hi. As Melissa said, I'm Matt Shoger. I'm staff attorney with the Office of the State Bank Commissioner. I've worked a little bit on this bill. All right, so you're asking about substantive changes. There are a few substantive changes. So as Melissa mentioned in her testimony, there are, she gave an example. I guess you don't have the page in front of you. All right, so there are, we're no longer requiring a particular computation method for mortgages for the finance charge, or how time periods for mortgages are computed. We're no longer requiring several notices to consumers that aren't really meant to apply to mortgages. They were written for consumer credit, and then mortgages were added into the statute later, and all the consumer credit provisions were automatically applied to mortgages, even when they just add extra paperwork that the mortgage companies and the consumers have to complete, and banks have to complete too, and those no longer will apply. There's also, so we've mentioned the electronic transactions, making that more up to date. The definition of appraised value allows for more methods for appraisals. So they're automated, so it's not a purchase money mortgage. We've heard requests to broaden that definition. We used to say automated valuation model and had a really complicated definition, and no one really knew what it meant. So we clarified that and said it's a method acceptable, if there's a method acceptable to the commissioner, and we gave criteria for what would make it acceptable, reliability, impartiality, industry standards, and customs. The definition of the code mortgage rate, so the code mortgage rate is either 12% or the sum of this reference rate plus 5%. That reference rate stopped being published, the one that's in the code stopped being published back in 2013. So we changed that to a new reference rate that we think is very comparable. Over 20 years where the two were both published, the difference, average and median difference, are both 0.02%, very similar. So we updated that. There's a new exemption for licensing for entities that only hold assets and don't have employees. So if you have like a subsidiary that just holds assets, that does not have to be licensed because the other company that actually has employees, we do supervise, and so you would not have to have another license for subsidiaries. So there are a few substantive changes.
Any additional questions? See none, thank you. Are there, Senator Olson?
On the appraised value, that concerns me a little bit. Are you gonna open it up? I mean, what kind of methods are you gonna open it up to? Because if you get too far off appraised value on a loan, that concerns me.
1 second. So the change only is for this, it's a fallback appraisal method. So it would not apply to purchase money mortgages, would not apply, and it does not allow predetermined valuations or valuations where the fee depends on the valuation reached. Those things are not changed about that provision. The old.
Like a renewal where they've already got the loan on the books, or, so it's not for purchases, so it wouldn't be the first loan.
I believe that's correct. I could look into it more and get you a response afterwards.
Yeah, I would like on first loans at least to have appraised value. It'd be dangerous not to.
Yes, it wouldn't apply to purchase money real estate transactions, so I don't think it applies there. Problem.
Thank you very much. Are there additional proponents to Senate Bill 242?
Mr. Chair,
You should have written testimony from A.W. Pickle and possibly Luke Bell.
I believe we do, and we'll get those in your folders. Eileen, did you?
yeah, can I just reference one part of Senator Pittman's question regarding doing things in phases and updating the language? So Senator Pittman, I just wanted to say, part of your question referred to phasing in or doing this process in phases, and I think what you said was, clarifying some of the language was something that was worthy of consideration. What I wanted to say is that the Uniform Consumer Credit Code is just that. It's uniform. It's been adopted by a number of states, and the language is essentially uniform among the states that have adopted the code. By picking it up and moving it, we've transferred it to essentially Kansas statute where we can amend that language, whereas the reason why it hasn't been amended in the UCCC is because there's actually a uniform law commission. We have uniform law commissioners, of whom, my boss is one. They go to an annual convention or, meeting. They have studies that they do, and they're the individuals that kind of weigh in with what needs to be changed, what projects they need to work on, what new acts need to be enacted, so on and so forth. So I would caution against the idea of, hey, we can just jump into the UCCC and modernize that language, because it's not really something that's easily done. And that's all I wanted to say.
Thank you, Eileen.
Sure.
Is there anyone who wishes to testify neutral to 242? Okay, we'll turn our attentions to the opponents. We have Kelly Van Zool with the Kansas Bankers Association. Committee, be easy on her. This is her first time testifying in the Kansas Senate. So.
Good morning. Thank you, Chairman Longvine and members of the committee. Everyone did a great job talking about this, so I'll keep mine pretty short and sweet. Like Melissa said, we understand the intent behind this bill is to help benefit non-bank mortgage lenders and create a one-stop shop for them. But in doing so, we believe it doesn't provide any benefit to the banking side and in fact causes a couple problems for them. Like Melissa mentioned, we believe there'll be some confusion. Right now, banks are not subject to the KMBA, so this is not a body of law that they are ever used to looking at. If this happens, they will have to look at the KMBA, and they will still have to look at the UCCC, because they still do other loans that would apply under the UCCC. So it wouldn't be a one-stop shop for the banking industry. Like Melissa mentioned, we also believe there would be some cost to this, as they would have to redo their forms. Currently, their loan forms mention specific provisions of the UCCC. Those would have to be updated to the KMBA. Again, this is a cost that we don't really see providing any benefit on the banking side. We did appreciate that the OSBC reached out to us, and we had many discussions with them. We took this bill draft to our State Affairs Committee, which is made up of bankers across the state, and that's where we received this feedback. They also cautioned about opening up and dismantling the UCCC in this way. We agree that it needs to be updated. I don't want to hurt any feelings, but the last time it was updated, I was not born. So we agree it needs to be updated, but we think, like Eileen said, it's a much larger endeavor. We'd love to be a part of that conversation with all of the stakeholders and work on that. We have provided an amendment. I've attached it to my testimony. We believe that this route would accomplish the goal of creating a one-stop shop for the non-bank lenders without interfering with the current operations on the banking side. Our idea here is to simply, inside the KMBA, reference the relevant provisions of the UCCC. So then a non-bank lender would go to the KMBA, which they're always used to working in, and it would give them all of the sections of the UCCC that are relevant to them so they know exactly what they need to look at, and this wouldn't disrupt anything on the banking side. Thank you for the opportunity, and I'm ready to stand for any questions.
Thank you, Kelly. Committee, are there questions? Oh, you're not getting off that. Kelly, could you explain to the committee where the white goes when the snow melts?
You know, this is a terrific question and one I put a lot of thought behind. No, I do not have an answer to that question.
Last chance for questions of Kelly. Senator Fagg.
I'm not going to let her off that easy, too. Frank Dodd's Act, you know, that was just a mess for banks as we went through that process. How does that affect in this whole picture of what they're trying to do with the type of things that we do?
How would moving these provisions affect the Frank Dodd's Act?
Taking, you know, UCCC over the mortgage and you got that. I'm concerned about the federal laws, you know, how that all fits, or is that all in the UCCC side of things?
So these are separate from the Frank Dodd, and Kathy can correct me wrong, I don't believe there would be any crossover or worry here.
All on that, okay.
Yeah.
Is that true?
I got my big boss backing me up here.
Okay. Any other questions, committee? All right. Thank you, Kelly.
Thank you.
Is there anyone else who would like to testify in opposition to Senate Bill 242? Seeing none, we will close the hearing on Senate Bill 242. Committee, to give you a quick update, tomorrow we are going to hear Senate Bill 245, which is a securitization on and bonding bill for utilities. Next week is our last week to meet on Senate bills, and so the tentative schedule at this point is we will not meet on Monday. On Tuesday, we will hear Senate Bill 135 and Senate Bill 225. Those are both Capers bills that deal with KP&F. On Wednesday, the 24th, I plan to work Senate Bill 37, Senate Bill 178, which we heard today, and Senate Bill 245, which we hear tomorrow. So if you have concerns or questions or amendments on those, if you could get with me, that would be helpful. On Thursday, we will hear Senate Bill 199, and Friday, we will not work unless we need to work to complete work taking bills either left over from Wednesday or additional bills that come up. Any questions on that? They are. Okay. Seeing no other questions, we are adjourned.